Now to the U.S. housing market. From one point of view, things are looking up. Home prices for one and mortgage rates too. So is this good news or bad? Here to help us out is Carmen Wong Ulrich, an industry professor in finance and risk engineering at NYU Poly-Tech here in New York with us this morning. Good morning to you.
Good morning.
So we're seeing rates that are comparable to 2003.
Right.
But why are we asking? Is this a good thing or is this a bad thing?
Yeah, I was going to say, you're like, is this bad news? Well, it's not so much that it's bad news, it's just that it's good news that you must temper with something, which is reality. What's really causing this boom right now? Because the reality is that unemployment is still very bad. We see wages are still stagnant. Those are the two usual indicators that mean that the housing market, there's going to be more buying and selling. The trouble here is we see a lot of institutional buyers. California flipping, remember flipping from back in the day? It's back up. Doubled. It's doubled this past month.
Wow.
So when you see indicators like that, and also three big banks just pulled a bunch of thousands of foreclosures off the market. So that artificially affects supply and demand. So we've got some pent-up individual buyers who are waiting on the sidelines. They're in now, but I would be very cautious to think that this is going to continue.
Well, what about interest rates here? Because, I mean, there's some panic going on here. We've jumped above 4%. I mean, we're sounding like that's an outrageous number. You know, those of us who remember when we were up at 8. But, you know, they're still very low, but they are going back up. I mean, do you think that trend is going to continue?
Well, how about 18 in the 80s?
Yeah.
Okay, so there should be absolutely no panic here. They have no place else to go but up. So they are going to go up. So there's no reason to panic. The key thing here is that it's really cut into refinancing, which was a huge cash cow for banks, right? And for people in general. I know I refinanced during all this as well. But there's still about a third of the American market that individual buyers could refinance. There's about a 1-point spread between the rate they have now and the rate they could get. The trouble has been having equity in your home. Because home equity dropped so far, they weren't able to refinance. So hopefully they can still capture some of these low rates as the housing market improves.
One of your theories also is that boomers will have all these homes to sell and Generation Y will have no interest in the homes because they're not interested in suburbs anymore.
You know, this is a huge shift and it's pretty amazing. I'm very interested to see where this is going to go. Basically, those folks under 30 years old are much less likely to want to live in the suburban environments. Remember, big mega houses, SUVs, 1-hour commutes, those days are over and they're pretty much going to be over because what we're seeing is a whole generation that says, I want to be able to walk in my neighborhood. I want to have access to people and jobs. So their tendency is to live in urban environments. And there was a great poll by Trulia this week that showed that the majority of Gen Y wants to live in or just outside an urban environment. So this is going to change things very much.
Carmen, what effect are student loans having on this group then?
This is a big one. The $1 trillion elephant that continues to keep on growing. The trouble with young adults is not only is it hard to get the income to get the jobs, the student loans are going to really impede their ability to buy homes. So we're going to have to see how that plays out.
Student loans are nothing new, but it certainly will be new.
Not at all. I know them well.
Carmen Wong Ulrich, thank you so much.
Thanks,
Carmen.